Hello and welcome to CATEX-TV. I'm Tom Bailey in London. It's 4:30 p.m. in London, 11:30 Eastern Time and 12:30 in Bermuda. Today in history, today in 1934, a fire destroyed the town of Hakodate in Japan, killing 1,500 people and injuring 1,000. Today in 1952, a Dutch DC-6 airliner crashed near Frankfurt, killing 44 people. And today in 1992, US Air flight from New York to Cleveland crashed on takeoff at LaGuardia, killing 27 people. Today, in the middle of today's broadcast, we're going to be screening an interview that was recorded yesterday. Yesterday, Frank Fortunato, CATEX's usual anchor, interviewed Peter Montanaro, who is head of the Lloyd's Delegated Authority Unit. Peter Montanaro visited the CATEX booth at the American Association of Managing Agents at a gathering in Dallas, and as I say, was interviewed by Frank Fortunato. So we'll be showing that interview midway through this broadcast, so please stay tuned for that. According to Lloyd's broker RFIB, Robert Fleming Insurance Brokers, insurers will be protected from any potential political risk losses from Libya because there's been no official declaration of war. The Lloyd's broker said insurers will be able to contest political risk claims in Libya. The Middle East director Anthony Harris said those who have insured or reinsured Libyan facilities will be able to contest any claims that are made on the grounds that this is a war situation. This is because we haven't declared war on Libya, but we're claiming under the 1973 UN Security Council resolution that we have full legal backing to attack Libyan targets in pursuit of the aims of the resolution, which is to protect civilians. He continued, we are in fact destroying Libyan targets. It's an act of war, but this would be excluded from claims. However, a Gulf expert, Faris Abiali, who is with the risk group Exclusive Analysis, said that insurers face claims due to disrupted oil supplies. He said, we're probably going to see Libya's oil production declining, and that means some of the contracts for oil delivery and the timely delivery will be frustrated. Harris believes that the keenness of insurers to work within the region following improved relationships with the UK in recent years has led to more insurers placing themselves at risk. He said Libya has been emerging in recent years and insurers have been trying to get their hands on assets. This has begun to happen in the construction and energy fields, but I imagine everything has been put on a hold for now. Well, following the interview with Peter Montanaro, we'll be looking at the latest slew of reports that have come in from various insurers on their expected losses from the Japanese earthquake and tsunami, and indeed some are still reporting on the New Zealand earthquake. Clearly it's been a pretty disastrous year in terms of natural catastrophes. We're also starting to get towards the Atlantic hurricane season, and I think a series of losses there could indeed tip the market quite heavily into a hard market. What we're going to do now is we're just going to look at some analysis that has come out on mean sea temperatures in the Atlantic, in the northern Atlantic, and these are what drives the formation and indeed the intensity of hurricanes. So this first picture you look at, these are the average temperatures for March for the North Atlantic at this time of year from 1971 to 2000. The second picture shows you the average temperatures for the last 7 days. So that can show you sort of how those temperatures are looking at the moment. And most importantly, the third chart here shows you the variance from the average that we're currently experiencing. So this is some analysis that we'll be able to come back to over the next few months and look at how things are changing. As you'll see from here, the further the color goes from green through yellow and then to red, the more the temperatures are above the mean average. So I think what we're seeing here is that temperatures are perhaps 1 degree above average in the central northern Atlantic, and that is of course the sort of incubating ground for hurricanes. So as I say, we'll continue to look at these. The green and certainly blue is below average temperatures. So there's no clear-cut picture here except that the eastern and central northern Atlantic seems to be a little bit warmer than one would expect for mean temperatures at this time of the year. What we're going to do now is we're going to show you that interview I mentioned earlier. This is an interview that Frank Fortunato held with Peter Montanaro, who's the head of the Lloyd's Delegated Underwriting Unit, and it was recorded yesterday at the CATEX booth at the Association of Managing General Agents in Dallas. So we hope you enjoy this, and we'll be back with you shortly. Thanks.
On the phone now with Peter Montanaro, who's the head of the Delegated Authorities Unit at Lloyd's. Peter is speaking to us today from Dallas. He's out there at the American Association of Managing General Agents Conference at the Fairmont Hotel in Dallas, Texas. Peter, how are you?
I'm well, thanks. I'm well. I'm enjoying the conference. It's very good. I mean, last year was good, but this year's an improvement on last year. So yeah.
Well,
having a good time.
That's good to know. Actually, delegated authorities have become pretty hot news lately. I think in the structure of Lloyd's, at least the last time I looked at an org chart, you're somewhere under Tom Bolt, and Bolt is being quoted frequently on the need to get better data for the delegated authorities. Is that something you're...
Absolutely. Yeah, delegated underwriting is one of the key areas of the Lloyd's strategy for the next 3 years. We see it as the key distribution channel for Lloyd's, so we're trying to extend our number of cover holders. Cover holders is what we refer to MGAs as in London, and which is good for me personally, of course, because that's my department.
Mm-hmm.
So, and Tom is very keen that those cover holders we welcome in meet all the criteria necessary to enable them to operate properly for Lloyd's. So yeah, it's very high on everyone's agenda, which is good for us, and is really why I'm here in Dallas today.
One of the things we noticed on the Lloyd's business plan going forward, I forget its exact title on the website, is that Bolt is very clear, as you just mentioned, about the expansion of the delegated underwriting authority book of business over the next 3 years. Can you clear something up? We hear continually different numbers on what percentage of the premium dollar are represented in Lloyd's by the delegated authorities.
It's 21% is pure cover holders,
Mm-hmm.
21% of our income, and then if you include service companies, which are cover holders that are owned by our managing agents, it takes the total up to 30%, just over 30%. So it's around about 5 billion annual income sterling.
Now, if we applied the typical pro rata proportions of the American portion of Lloyd's business, just ballpark-wise, what does that then come to for American cover holder business?
Around half our cover holder income comes from the U.S.
So that's about
the largest digital market for it.
about $2.5 billion a year sterling.
Yeah.
No, that's not chopped liver, as they say. That's quite a bit of money.
No, so
Yes.
We've got around about 900 cover holders in the U.S.
Well, speaking of which, one of the things that we found, we've been out, as you know, CATEX owns CATEX Solutions, which produces the Pivot Point Broad Order Management System. And one of the things that we found out in the hustings as we've been talking to some of those 900 plus Lloyd's cover holders in the U.S. is that, oddly enough, some of the same issues that are presented to the syndicates are mimicked even at that level. The syndicates, as is well known, and as is what is really your remit, it seems these days, making sure that the incoming data from all the various cover holders is uniformly tracked and being able to pull out on a very disaggregated level any particular insured risk. The cover holders themselves seem to frequently not be the originators of the business, but in fact then intake the business from a multiple of different retailers. So the cover holders, in fact, are complaining to us that their incoming data that they then have to prepare to send onward to the syndicates is coming in a manner that we always refer to as different cats and dogs. Do you, in your perch from London, do you see it getting down to this level, all the way down to that close to the actual first check writer?
I mean, that's how we hear things are, and clearly that's not good enough. Going forward, we need to change that. I mean, the utopia is that the information that's loaded on by the retail agent, nobody then touches it again until it gets through to London. So we need to have standard data, and we need to have the systems in place to control the quality of the data that comes through. So I think the guys from AAMGA call it a war on keystrokes. So
yes.
less human intervention from the retailer all the way through to the syndicate, then the better for everyone. We are a long way from that utopia in terms of across the whole market, but we are seeing sort of green shoots. There are already a number of cover holders and retailers that can work direct with no manual input after their original input all the way through to the underwriter. We just want to increase those numbers. And, you know, at the end of the day, bordereau management systems like the ones that you guys do and many of your competitors who are here on this conference are an important step for us to go forward with that, not only in terms of managing our business more efficiently. Lloyd's syndicates need to manage their aggregates properly, which means we need up-to-date, really real-time data as to what's being written, and the requirements of compliance are getting greater and greater, which means we need to be analysing data at a far more granular level than we ever have before, and we can only do that with quality systems in place.
Well, from your lips to God's ears, if it might be of interest to you that even down at the levels closest to the original check writer, we find a knowledge and awareness that there's a push coming from the other side of the equation, coming from Lloyd's, coming from determination on the part of the London-based regulators, if you will, in order to get more disaggregated, clean data. So the message is being heard. Could you talk a little bit about, will this be out in front of Solvency II, or do you expect that the Solvency II standards, when they finally appear in London, will perfectly be in set with what you're talking about?
I think a lot of what we're looking for is in keeping with where Solvency II will take us. I mean, there needs to be a clear audit trail for all underwriting decisions made and data collected. So I think actually the DA world is in a pretty good place as far as Solvency II goes with the controls we've already put in place. But bordereau management systems that are coming on will help support that and to clear some of those issues up. So Solvency II is going to have a big impact on the way business is managed. But actually, because of the work that a lot of the syndicates, our London brokers, and many of our MGAs have already done, I actually think we're in quite a good place.
Mm-hmm. And then one final question. When we read in the Insurance Day, Tom coming out talking about how these standards, insofar as being able to pull in and submit this disaggregated data, are ultimately going to become requirements, necessities. It always seems that it's a little bit sotto voce there at the end. Nobody wants to put the hard stop in, insofar as saying, by this date, X and Y and Z have to be done. Has anything like that come out yet, or where are you guys in thinking about making the requirements mandatory, and by when?
Now, on the standards, we've mandated our standards for all new cover holders.
Mm-hmm.
In part, that's because it's easy to do it for
yes.
guys, because they want to come into Lloyd's and they'll pretty much agree to anything at that stage. And we might as well have them already at the high level that we'd want them to be.
Yes.
In terms of our existing population of cover holders, I think in time they will all come round to what it is we're trying to do anyway. So I don't believe we're ever going to have to mandate this, because the reality is that for the cover holders to be able to perform equally against their peers, they're going to need to provide this quality of data anyway to our market, and our market is going to need it so they can manage their aggregate properly, and so they can ensure that all compliance matters are managed properly. So, for example, we expect all our syndicates and our cover holders to know that they're not in breach of any international sanctions, for example, with regard to who they may or may not be insuring.
Mm-hmm.
If you haven't got good systems that can read the business that you are writing, then that's something you're having to do manually, which effectively is not going to be cost effective against your competitors. So I hope that we don't end up having to mandate these standards for the rest of the market. I would expect that because what we're asking for is common sense and it's for everyone's common good, that ultimately everybody will move towards the standards anyway. And if the information we're getting and the sense we're getting from the Dallas conference is anything to go by, the MGAs are very keen to push these standards forwards as well. So I'm hoping that they will encourage our underwriters, as indeed the brokers already are, to embrace these standards as well, so we can all work together to roll them out as quick as possible. And of course, we have standards, that makes life a lot easier for the system vendors as well, because they know exactly what it is they have to put in their solution to meet everybody's requirements.
Well, very good, Peter Montanaro. Thank you very much for taking the time to chat with us today. And I suspect the weather in Dallas is certainly better than here in New Jersey. It's about 37 degrees Fahrenheit, overcast and drizzly, so presumably it's better there.
It's nice here, and it's certainly nicer here than it is in London.
Well, touche. All right. Well, listen, thank you for your time.
And now back to the news. A number of companies have now reported on their expected losses, both from the New Zealand earthquake and from the Japanese earthquake and tsunami. Bermuda-based insurer and reinsurer Argo Group International Holdings estimate that its pre-tax losses from last month's earthquake in New Zealand will be in the range of $35 million to $45 million. That was the earthquake that caused massive damage to the city of Christchurch on February the 22nd and left more than 150 people dead. Swiss Re has now released this morning its preliminary estimate of its claims cost for the Japanese earthquake and tsunami. These are its net claim costs, so that's net of retrocessional recoveries and before tax. And Swiss Re has estimated these to be at $1.2 billion. The reinsurer cautioned that these estimates are subject to a high degree of uncertainty as the event continues to unfold, making the loss assessment particularly challenging. Overall insured loss figures have been estimated by Equicat to be between $12 billion and $25 billion. Other estimates have indicated that losses could be as high as $35 billion. Swiss Re's Chief Executive Officer Stefan Lippe said, "We extend our sympathies to the Japanese nation as they cope with the human tragedy and destruction caused by this event. We remained committed to using our expertise and experience to support clients in Japan as they manage the risks related to such devastating events. It is the purpose of our industry to aid communities in their recovery and the redevelopment efforts." The bulletin also explained that a government-run insurance scheme provides cover for earthquake, shock, and tsunami for residential properties insured by non-life companies. This cover is not reinsured in the international reinsurance market. Now, Axis Capital Holdings said yesterday that disasters in New Zealand and Australia will cost it between $275 million and $315 million in the first quarter. The company said that it was too early to come up with industry or company losses for the Japan disaster, although it noted estimates of industry large losses in the range of $12 billion to $35 billion. So that was the figure that Equicat had come out with. Access said that it doesn't expect to bear more than 1.3% of the losses stemming from the reinsurance segment, and it doesn't expect to suffer more than $25 million in net losses to the insurance segment because of the reinsurance coverage. For earlier disasters, slightly more than two-thirds of Access losses will be for the New Zealand earthquake, with the rest from flooding and other damage in Australia. The loss estimates are before taxes. Now, we've seen quite a few people reporting their loss estimates. Obviously, Swiss Re have got an estimated loss, as I said, of $1.2 billion for the tsunami. A number of analysts have sort of been surprised. So William Hawkins, analyst at Keefe, Brewett and Woods, voiced surprise with Swiss Re had published a loss estimate so soon after the event. He said, we expect it results from a combination of clarity from the model about the loss and local stock exchange requirements to disclose material financial information when it's known. Hawkins said, this means the estimate carries a high degree of uncertainty, but we believe it's a figure that should reassure investors about the degree of financial burden being taken by the reinsurance market. So Swiss Re's loss estimate tops that of AIG, which emerged as the largest published individual Japanese loss estimate to date over the weekend, when it revealed that it expects to take a $700 million hit through its Chartis unit. As we reported earlier, AIG had previously established catastrophe reserves of $500 million for potential claims associated with the earthquake damage to personal dwellings. The US insurer said the maximum loss it could incur associated with earthquake damage to personal dwellings is $575 million, including claims filed with Fuji Fire Marine Insurance Company, which AIG has a 54% holding in. Chartis said it would post first quarter catastrophe losses of $1 billion, which is $900 million after tax, a result of first quarter catastrophe activity. Flagstone's obviously come up with its previously published estimates for the first quarter, including New Zealand earthquakes and floods. And what we've seen really is more and more companies coming out with pretty early estimates. Manulife have estimated $150 million loss. QBE, this is for the Japanese earthquake and tsunami, QBE have estimated $125 million. SCOR have estimated in euros $185 million. And Taiping Re, who report in Hong Kong dollars, said that they expect their estimates to be in the region of 75 to 100. One of the reasons that we're seeing so many people report so rapidly after these events is as Mr. Hawkins said, the requirement of local figures and the ability to get some sort of early modelling handles on these things. But I think what we can say is that we expect these early estimates to be relatively inaccurate, and they're likely to mature as the situation becomes clearer. Also in company news today, the technology firm Web Connectivity has been acquired by Advisen, which is a global insurance data and analytics provider based in New York, announced that it's acquiring UK-based Web Connectivity, a leading provider of messaging products and services for the commercial and reinsurance markets in both London and Bermuda. The terms of the transaction were not disclosed. However, the collaboration will allow both companies to further develop technologies and solutions offering increasing amounts of structured data to suppliers, buyers and brokers of commercial reinsurance. The growing use of structured data amongst reinsurance companies is enhancing communication and providing deeper and more actionable business analytics to the industry, facilitating straight-through processing and reducing frictional costs in the process. James Willison, the Managing Director of Web Connectivity, said, "We are confident that this acquisition provides Web Connectivity an even greater foundation for operations and product development initiatives." Tom Ruggieri, the CEO of Advisen, said, "The aspect of Web Connectivity's business that has most impressed us is their technology competency. We feel that this will further Advisen's efforts to encourage greater use of structured data in our industry. Our greatest achievements come when our clients gain financial success, and that success comes from greater connectivity." And finally today, Ajit Jain, who is extremely well known within the industry, is running Berkshire Hathaway's reinsurance business, has said that Warren Buffett at the age of 80 has more energy than he does. Indian-born Ajit Jain is seen one of the candidates who will succeed Warren Buffett as chairman of Berkshire Hathaway. Jain helped set up Berkshire Hathaway's reinsurance unit in 1986 when it was raining gold in the insurance markets due to a sudden hardening of rates, and has been the biggest cash generator for the firm. He quit McKinsey & Co. to join Berkshire after a call from his former boss who had joined Buffett. Jain, who left the country in 1976, is amazed how the difference between India and the West in terms of availability of products and services has been narrowed, although the income gap has widened. He narrates an incident of how 10 years ago, when his mother had to undergo bypass surgery, he took her to Mount Sinai in the US, but more recently, when she had to go undergo the operation again, she chose Apollo Hospital in India, and the anaesthetist turned out to be the same who treated her in the US. Jain is in India to launch BerkshireInsurance.com, an online distributor of motor insurance, and his foray into the retail market in India. In an interview with the Times of India, Jain spoke out about his plans for India, Buffett's succession plan, and the Japanese earthquake. It was during this interview that he announced that indeed he believes that Mr. Buffett has more energy than he does. Clearly very impressive. That's all from us today. We will be back with you at the same time tomorrow. Until then, thank you very much, and goodbye.